Export Connect NG, the fastest platform to connect with your foreign buyers. Hello everyone and welcome back to our channel. Payment and financing problems in international trade. 5 ways of using trade finance to overcome payment and financing problems in international trade. Welcome back to our channel. Today, we will be discussing an important topic for businesses engaged in international trade: how to overcome payment and financing problems using trade finance. International trade can be complex, and businesses often face challenges related to payments and financing. But fear not. In this video, we will share 5 ways to use trade finance to overcome these hurdles. So let's dive in. 1. Letter of Credit, LC. A letter of credit, LC, is a financial instrument issued by a bank on behalf of a buyer, guaranteeing payment to the seller upon meeting specified conditions. A letter of credit provides security to both parties and minimizes the risk of non-payment or default. It involves the buyer and seller agreeing on the terms and conditions of the trade deal. Letter of credit process. Buyer applies for a letter of credit from their bank, which assesses the buyer's creditworthiness and verifies the authenticity of the trade deal. Once approved, the bank issues the letter of credit to the seller, who can then ship the goods. Upon receipt of the required documents and compliance with the specified conditions, the bank releases the payment to the seller. 2. Documentary collection. A documentary collection is a process where the seller's bank collects payment from the buyer's bank on behalf of the seller. Not as secured as a letter of credit, but can be a cost-effective option for experienced traders with good trading relationships. Process of documentary collection. Seller ships the goods and submits the required documents to their bank, which forwards them to the buyer's bank. Buyer's bank notifies the buyer of the documents and collects payment. Once the payment is received, the buyer's bank releases the documents to the buyer, who can then claim the goods from the shipping company. Payment is not guaranteed, and disputes can arise, so careful consideration of the trading partner's creditworthiness is essential. 3. Export credit insurance. Export credit insurance is a type of insurance that protects exporters against the risk of non-payment or default by their foreign buyers. It provides coverage for commercial and political risks, such as buyer insolvency, protracted default, and political events. It gives exporters the confidence to extend credit to their buyers and offer flexible payment terms. It reduces the risk of financial loss due to non-payment or default. And it helps businesses expand into new markets and mitigate payment and financing problems in international trade. 4. Factoring. Factoring is a financing method where a business sells its accounts receivable, unpaid invoices, to a factoring company at a discount in exchange for immediate cash. It provides businesses with quick access to working capital to finance their international trade transactions. Factoring companies may also provide credit risk assessment, collections, and payment processing services, relieving the seller from the burden of managing receivables. It improves cash flow and reduces the risk of non-payment or default by transferring the credit risk to the factoring company. It can be used for both domestic and international trade, and can be especially helpful for small and medium-sized enterprises, SMEs, with limited access to traditional financing options. 5. Bank guarantees. A bank guarantee is a commitment by a bank to pay a specified amount to a beneficiary if the applicant, buyer or seller, fails to fulfill their obligations under a trade contract. It provides assurance to the beneficiary that they will be compensated in case of non-performance or default by the applicant. It can be used as a form of collateral or security for international trade transactions, reducing the risk of non-payment or default. Different types of bank guarantees include performance guarantees, payment guarantees, and bid bonds, among others. Bank guarantees are widely used in international trade, especially for large and complex transactions, and can help overcome payment and financing problems by providing security to both parties. So there you have it, 5 ways to use trade finance to overcome payment and financing problems in international trade. Whether it's through a letter of credit, documentary collection, export credit insurance, factoring, or bank guarantees, trade finance offers various options to mitigate the risks associated with cross-border trade transactions. By leveraging these tools, businesses can protect themselves against non-payment or default, improve cash flow, and expand their international trade operations with confidence. As always, it's important to carefully assess the specific needs and requirements of your trade deals and work with trusted financial institutions to ensure a successful international trade experience. That's all for today's video. We hope you found it helpful. Don't forget to like, share, and subscribe to our channel for more informative videos on international trade business. Ensure to click and watch all the series in our playlist on most common international trade problems and quick solutions suggested, so you can trade safely. Stay tuned as we see you in our next video. Bye. Thanks for watching.